So recently, the House passed a tax bill and it highlights some key aspects of where Congress thinks incentives should be held for individuals, business owners across the country. I want to give you a little analysis on the 2025 proposed tax bill. I've got some notes in front of me that I'll be glancing down, but I think you'll find this an insightful, eye opening discussion. So let's just jump right in. What do you say? Let me give you a little history for starters. Back in 2017, a big tax legislation was passed. It's called the Tax Cuts and Jobs Act. And it was slated to sunset or end at the end of 2025, meaning that starting January 1st, 2026, the tax law that was passed and that we've been in, what's been in play for 8 years now, will end and will revert back to Obama era tax legislation. Well, the Republicans got together in the House and decided that they want to keep a portion of what the tax bill was in effect. Sometimes either keep it the same, reduce it a little bit, and in a few cases actually kind of step on the gas pedal a little bit to get their agenda through. Now, of course, with any major tax legislation, there's things that I think personally should be changed, but I'm going to do my best to pull my own personal political feelings out of this, just like I normally do, and just give it to you on face value, what it means for you, because it's likely that a large chunk of these measures will be in the package that's eventually passed by the Senate and then signed into law by President Trump. So without further ado, what do you say we jump in? Number one, the permanent extension of the Tax Cuts and Jobs Act. So right now, the lowest tax rate, federal income tax rate, is 10%. So it goes 10 to 12. Then we get a big jump from 12 to 22. And then from 22 to 24% is the next bracket. And then we jump from 24 to 32, 35, and 37%, with 37% being the highest federal ordinary income tax rate for individuals today in the United States. Now, what they want to do is extend that into the future. That's fine, but just recognize that if it doesn't get passed, it will revert back on January 1st. 10 will become 12. What's 12 will become 15. What's 22 will become 25. What's 24 will become 28, and so on. It kind of goes that direction. So it increases a few percent, all else being equal. And just remember, with tax rates, you fill up one tax bucket, or what we call bracket, and then every additional dollar is used to fill up the next bracket. So I don't want you to think that if you're in the 32% tax bracket, that every dollar you earn is taxed at 32%. That's not the way it works. All right. They're thinking about elimination of personal exemptions. We won't get into the details there, but that could potentially impact a few individuals. They're going to increase AMT exemptions. So AMT is alternative minimum tax. This was a tax that was applied a number of years ago and applies to certain specific activities that people engage in. One common one that I see is with incentive stock options. This is equity compensation that your employer gives to you, and along with it comes some pretty beneficial tax perks if you hold on to the equity for a certain period of time. And essentially what it does is it shifts income from higher ordinary income tax rates to lower capital gains tax rates. AMT, in a lot of instances, can hurt those individuals that have incentive stock options. And so we want to do some good tax planning ahead of you receiving it. And then once it receives, you vest. And then once you actually end up selling the stock after you execute the option. Okay, that's big tax talk. But just recognize that the alternative minimum tax is a tax kind of like its own separate one off to the side. And it's used to make sure that if you pay too little in regular tax, the alternative minimum tax will require that you pay at least that amount. So they're increasing the exemptions on that. The next one is $750,000 of mortgage interest deduction capped. Okay, so just recognize that if you have a mortgage and you live in the home, that has a mortgage connected with it as your primary residence, you can deduct up to a certain amount of interest on that home. And there's a limit on that. And then they're going to get rid of some miscellaneous itemized deductions. So that doesn't influence most individuals. Okay, number 2, the second category here, standard deduction enhancements. Remember, when we're looking at taxes, we look at your itemized compared to your standard. So essentially, standard deduction says if you can fog a mirror and if you're breathing, right, then you can take a deduction, and it's roughly $15,000 if you're single and $30,000 if you're married filing jointly here in 2025, roughly that amount. In other words, the first $30,000 of income that you generate if you're married filing jointly is taxed at 0% because it's deducted. So let me give you another example. Let's say you make $100,000 as ordinary income in a year. You're only going to be taxed for federal income tax purposes on $70,000 of that because $30,000 is your standard deduction. Itemizing is where they add up very specific things, such as interest on your mortgage if it's a primary residence. Of course, if you have interest on a rental property, you can deduct that, but we're talking about the home that you live in. It's different. Deduction for charitable giving, deduction for healthcare related expenses above a certain amount, above a ceiling, state and local tax deductions, what we call SALT. You add all these up, and if the sum of these very specific numbers is greater than your standard deduction, wonderful, you're going to take an itemized deduction in that year. Otherwise, you would do the standard deduction. And since the passing of the Tax Cuts and Jobs Act back in 2017, roughly 9 out of 10 Americans are taking the standard deduction. That means that the interest they're paying on their mortgage, the taxes they pay to their state or as part of property tax, and their charitable giving, they're getting no tax benefit for at the federal level. That may be a surprise to you. You may have thought that there's a little bit of meat on that bone. You may have thought you were getting a tax benefit for the interest on your mortgage, but odds are you're not getting it. Or if you are, you're rare, roughly 10%. So what they're thinking about doing is extending the higher standard deduction. It used to be much lower, but they increased a higher standard deduction back in 2017. Again, that would go back down if the law was not passed by the end of the year. There's a new bonus deduction here for $4,000 if you're over the age of 65. It's phased out if you have higher income. Right now, if you're older, 65 plus, you get a little bit of a deduction. It's not as much as $4,000. Okay, third category here for changes that have come about from the House tax proposal that was passed: an increase to child tax credits. Now, this doesn't apply to all of you, but it applies to me because I've got 2 young kids. It's temporarily increased to $2,500 a kid. And that's just for 3 years, from 2025 to 2028. So if you didn't know, with tax law, they may pass certain pieces of legislation, but have start and end dates on some of them. Think about this year, for example, in 2025 with 401ks. If you're between the ages of 60 and 63, you get a couple $1,000 extra catch-up contribution. It's just over $11,000. Yippee. But don't ask me why. It's just between when you're 60 to 63. How come it's not when you're 64 or 65? Certainly, there are individuals who would love to save more for retirement, but for whatever reason, it's just those few years there. And it just started in 2025, even though it was passed a number of years ago that put this into effect, namely Secure and Secure 2.0. And those are 2 pieces of legislation that have had really kind of thrown the financial and tax planning world upside down. So especially as it pertains to inherited IRAs. So just to recognize, as we talk through some of these tax proposals, that this isn't anything new for them to have a start and an end date on some very specific pieces of tax legislation. It will return to $2,000 a kid in 2029, indexed for inflation. So a lot of things are indexed for inflation, but some are not. For example, when it comes to the wage base and Social Security and Medicare, There are some things that are indexed in terms of what's taxable as a Social Security benefit and what's not. And the benefits are increasing, but the amount that's subject to tax has been relatively fixed for a very long time. So it's nice to see that with the child tax credit, there's a little index for inflation there. And then $500 credit for other other dependents that are retained. All right, section number 4, the SALT deduction cap is raised. Remember, SALT stands for state and local tax. Now you're going to sound like the cool kids when you talk about the SALT deduction. So it's increased big time. Right now, if you pay state and local taxes over $10,000, you don't get any benefit above $10,000. Like it's capped at 10 grand. But what they are suggesting here in this tax proposal that has passed at least the House is to crank that puppy up from 10,000 to, drumroll please, 30 grand. That's a huge increase in the state and local tax deduction. So if you live in a state or you just have high income tax or other taxes you pay wherever you are, maybe not necessarily in a high income tax state, but for example, if you live in a California or in New York or in Illinois or some other place, boy, this is going to be very valuable to you because now you're getting some federal income tax benefit for your state and local tax. Even if you don't live in a high income tax state, but you live in a state that has high property tax, it could still benefit you. So shout out to those of you who live in Texas, Florida. You know what I'm talking about. Okay. It's phased out between 400,000 to 500,000 for joint filers. There's a few other things, but we won't dive into the weeds there. We're trying to keep it top level for you today. This is not for continuing education for CPAs or tax attorneys. We'll leave that discussion maybe for another one of my presentations. Okay, Section 199A deduction. This is what we call QBI, Qualified Business Interest Deduction. So if you're a small business owner, boy, there's some benefits here to you. Essentially, they're going to permanently extend and increase the deduction from what is 20% to 23%. That may not sound like a lot, but the QBI was probably one of the biggest pieces of tax legislation that helped small business owners. And so, hey, every little bit counts. There's going to be new phase-out rules for what they call specific service, trade, or business owners. We won't dive into the weeds there, but just recognize you're a small business owner. This is a benefit for you. Number 6, there's going to be some new deductions that were introduced and passed by the House. Number 1, and you've heard this before, no tax on tips and no tax on overtime income either. This is interesting. This has been kind of the big hoorah for the Trump team, not only while they were on the road pre-election, but since then as well. So no tax on tips, no tax on overtime. These deductions there has to be qualified income. So that's one. The second is auto loan interest deduction up to $10,000 a year. So if you get a car, whether it's new or refinance loan, if it was built in the U.S., and built means assembled, then you get some tax deduction for the interest you pay on that. Now, that's going to do some weird things and create some unique incentives, I think, for individuals who would otherwise just pay cash for cars. They might now be a little bit more incentivized because of the tax deduction that they get on the loan. Now, I'm sure Dave Ramsey is going to continue to keep the flag on the hill there with getting out of debt and paying cash for vehicles and not buying more than you can afford. And certainly I agree with him a lot on that point, because when you don't have a car payment holding you back, I've just seen it in action. You're able to save and invest much more for your future. But that is an interesting deduction that's coming around as a way, I think, to incentivize people to buy vehicles that are built or assembled here in the United States. Number 7 for the 2025 House tax proposal, estate tax exemption. So this applies to what we call high net worth individuals or high net worth families. And estate tax, or what we sometimes call the death tax, is where the government comes in, and each state has their own, whether or not they do an estate tax is dependent on where you live. But from a federal income tax perspective, federal estate tax or death tax perspective, the proposal is $15 million per person, $30 million if you're a couple, starting in 2026. That's big time because right now it's kind of in that $13 to $14 million range, and it was supposed to go back down. Most kind of experts were thinking in the $7 million range per person, but that's huge. So if you're a high net worth family or you expect to have assets when you die of $15 million or more if you're single, or $30 million or more if you're married, then we want to do some estate planning. And we've got a lot of videos and content on that. I talk about that in my book as well, Finance on the Fly, Simple Strategies to Build Lasting Wealth. So check that one out. And it's going to be indexed for inflation thereafter. Again, these are permanent. That's interesting because the Tax Cuts and Jobs Act, these were temporary adjustments, but this is now making it permanent. What does that mean? It doesn't mean a whole lot more because tax law, as we say in the accounting world, is written in pencil. So don't think that it's hard-coded here in ink. It can be adjusted and changed. If new people are elected down the road and they want to overhaul the tax system, it can certainly be changed, but it's more permanent than the Tax Cuts and Jobs Act because there's no expiration date on some of these provisions. Number 8, 529 plans are being expanded. So K through 12 expenses, which include tutoring, testing, therapy, as well as post-secondary credentials. For example, I'm a financial advisor. So if I got my certified financial planner designation, my CPA, certified public accountant designation, there's a few others, but the CPA and the CFP, come on, those are the ones that we like, right? Then the costs associated with me to get those credentials or those certifications can now be run through a 529 plan. That's huge. So they're just expanding what a 529 plan can do. You'll recall a number of years ago that the 529 plan got a huge boost because now money could be rolled over to a Roth IRA up to $35,000 per individual or beneficiary over their lifetime. That's a huge benefit. And really 529 plans in the last few years have just been elevated. They've been taken up to the next level. It was rare a number of years ago that we talked all that much about a 529 plan for individuals and families who want to save for education costs or for college. I mean, it was kind of limited. But boy, now it's expanded to include things like trade schools, high school, elementary school. Shoot, it even goes down to kindergarten. I probably would not recommend anybody to be using 529 money for kids in kindergarten because you're really not getting the big benefit of the tax-free growth that you enjoy inside of a 529. Just remember, when you make contributions to a 529 plan, in some states you get a little bit of a tax deduction or maybe a tax credit. But if you live in California, you're getting squat at the state level. But the benefit here is from a federal income tax perspective, it can now grow unburdened by taxes, which is why a lot of people all over the country choose to use a 529 plan that's not necessarily affiliated with their state. For example, I live here in Utah. Utah has one of the best 529 plans in the country. Folks from all over the country use Utah's 529 plan for kind of 2 or 3 reasons. Number 1, low fees. 2, great investment options. And 3, a pretty user-friendly website and interface. And so whether or not you decide to send your kids to school in Utah, or you use a private school, or they go somewhere else, boy, it gives you a lot of options and flexibility with the 529. But just recognize that it still has some restrictions. It'd be unwise for you to save money in a 529 if you wanted to pay for a kid to, I don't know, buy a home for the first time or start a business, pay for wedding costs, or pay for them to go on a honeymoon, or maybe you want to pay for them to serve a mission, whatever the case may be. 529 has some limitations there. All right, next Up. Section 9, HSA reforms. All right, the HSA, the moment you've been waiting for. If you've read my book, Finance on the Fly, Simple Strategies to Build Lasting Wealth, you know the chapter. It's called The Holy Grail, because the health savings account is, in my mind, the Holy Grail. I'm remembering Indiana Jones as he's coming up, and like, what a great movie. You gotta love Indiana Jones. And actually, just in January, I was there where they filmed that scene. If you'll recall, right before, it's actually in Petra, so in southern Jordan. He's walking up the red sandstone cliffs, and he goes through all the different I want to say adventures. It's not adventures. They're kind of like risks, pitfalls, and he makes it all the way to the one of the last Knights Templar guarding all the different cups in there, the chalices, and then he gets the Holy Grail. And it's a great movie. It's fantastic. But the HSA is, in my mind, kind of the Holy Grail of investing accounts, because, as you'll recall, money you put into an HSA goes in tax-free. In other words, you get a tax deduction. It's even better than just a tax-free contribution. It's a tax deduction, so it reduces the amount of taxable income you're subject to. You invest in the HSA, it grows tax-free, and then you can take the money out down the road for qualifying medical expenses. So here are the changes from the House bill that was passed. Contribution limits in 2026, drum roll for this, doubled. HSA contributions doubled. That's incredible, ladies and gentlemen. That has never happened in my lifetime, as far as I'm aware. I mean, this is huge, groundbreaking stuff. For them to double the amount that you can contribute to an HSA, let me just give you some numbers here. In 2026, if you're an individual, $8,600. That's awesome. Shoot, the family contribution this year in 2025 is not even $8,600. It's $8,550. That's huge. I know. Why do they do $50 increments? Hey, I'm not the ones you elected to put this into tax law, but at least they rounded it up here, $8,600 and $17,100 for a family. Pretty good. Now, why don't they just double it? I don't know. Personally, I think it's stupid. Like, just double. Individuals, 8,600. Family, they should just double it and let's go. But they don't. They knock it down $100. Whatever. $17,100 to an HSA in 2026 if you're a family. Now, hopefully, again, this is just the House we're talking about. It's got to pass the Senate and get signed into law by the president. But this is pretty juicy on the HSA side of things. And if you have a qualifying high deductible health insurance plan, ooh, this is good stuff. And now, if you're thinking about signing up during the next open enrollment, so if you're a teacher, it's kind of right now, but for many of you, it's towards the end of the year. October, November, December is when you have open enrollment for many of you. This is something that may just kind of put you over the edge and say, all right, I'm going to pony up. I'm going to get the high deductible health insurance plan because the HSA has become so much better. So big win for the HSA. This takes the Holy Grail to the next level because of how much you're able to fund into a health savings account. Plus, there's expanded eligibility and opening of qualified expenses. So they're now considering fitness costs, for example, as being eligible for HSA distribution. That's huge. This is huge. I mean, if this actually gets passed into law, I'm just thinking out loud here. As a financial advisor, this may put it above the Roth IRA in terms of the order of operations that I would recommend many of the clients and families I work with to go through. I mean, normally order of operations goes something like this, right? You make sure you're out of stupid debt. You make sure you have an emergency fund. Those kind of go hand in hand. And the emergency fund, we might start out with a couple bucks, but I want to see you closer to 3 to 6 months of living expenses. 3 months if you're a dual income household, maybe closer to 6 months if you're a single income household. Once we're there, next step is, hey, let's take advantage of free money. So 401k, as an example, if you put some money in and then your employer does a matching contribution, we want to be sure we're doing enough to max out the match that an employer is giving us. Then I might say HSA, like let's crank that puppy up. There may even be instances in which I might recommend to an individual to actually start with the HSA before the match. Now, those would be pretty rare, but this really is a compelling argument to make. And then the Roth IRA might come after the HSA. Yeah, I mean, no, historically, if you ask me right now, and again, based on current law today, I would say the Roth IRA and the HSA, they're kind of hand in hand. They both have phenomenal, exceptional benefits. But with the new passing of the House bill, cranking it up to $8,600 as a contribution in 2026 for an individual, $17,100 for a family. Ooh, that is ripe for the taking. And I might put the HSA above the Roth IRA contribution and above putting more money into a 401k above the match. I would probably put it right there. Pretty powerful stuff. Okay, number 10. Money account for growth and advancement accounts, the MAGA account. So this is a new child savings account. You may have heard about it. And it's going to start supposedly with $1,000 of federal seed funding for kids who are born between 2025 and 2028. So I'm stoked for this. I had a kid born in 2025. We'll see if he's in the window here. But hey, I'll take the $1,000 to jumpstart an account. Okay, so a little bit of seed funding. That's enticing for some. I think that's because for whatever reason, those in the house at least want to see more babies be born in the next few years. Number 2 on this portion, so we'll say sub number 2 here, contributions are up to $5,000 per year adjusted for inflation. Now, there's some tax benefits, they're somewhat limited. There's some strict withdrawal rules associated with these. But if this actually gets passed, you better believe Rizek is going to be one of the first jumping on these accounts and opening them, because I think based on how they're structured, this could be pretty juicy. There's a lot of lemon to squeeze out of this one. That was a bad analogy or metaphor. I'm not sure of the difference. I need to go back to my high school English class. But I will tell you, there's a lot here. Right now, we kind of have 3 accounts we use for kids, at least that I recommend typically. The 529, great for education, and looks like it's going to be expanded. Then we have what we call a UTMA account, Uniform Transfer to Minors Act account. There's 2 states, South Carolina, can't remember, New Hampshire or something else. UGMA is what they're called, but UTMA for most of you, this is a custodial, or sometimes we call like a quick and dirty trust account for a kid. That's an option. And then the third would be just a regular brokerage account for a minor. This is the same structure from a tax and legal perspective as a minor account. You might open that a checking savings account for a kid at a bank or credit union. So that's going to fall under those categories. There's a few other ones we might use in unique situations, like a Coverdell ESA, for example. I had a question on that yesterday, I think it was, on saving for kids that way and choosing individual stocks. That's an option, but essentially it boils down to the 529, the UTMA, and a brokerage account. This MAGA account would be the 4th, and there could be some pretty exciting opportunities here. So stay tuned. Don't hold your breath on any of this stuff, because the Senate still has yet to kind of pass this into law, and it's yet to be signed, but that's something to keep an eye out for. The Money Account for Growth and Advancement, the MAGA account. Number 11, Qualified Opportunity Zones. Okay, so Qualified Opportunity Zones, this is again passed years ago as an incentive primarily for real estate investors to put capital into specific geographic regions, either to revitalize the area, increase the value of the neighborhood, just kind of get certain areas of the country back in the swing of things. There's a lot that could be said here, politically and otherwise, as to whether or not they worked or it had the intended effect. But it incentivized investors because it provided some tax deductions, or maybe not tax, we won't say tax deduction, we'll say tax deferral. So you're just kind of kicking that can down the road, and to avoid capital gains tax on other investments that they had. So that's interesting. The new round is going to go from 2027 to 2033. Similar deferral and exclusion benefits as the original program, just to add in incentives for rural investments. Number 12, clean energy credit repeals. So they're going to end credits for electric vehicles, solar panels, energy efficient home improvements after 2025. There's a lot that kind of goes in there. We won't dive into the weeds, but that is something that was passed by the House. And number 13, so just some kind of other random ones as a catch-all here. Student loan forgiveness. Boy, that's a big one. That's huge. And employer repayment exclusions are made permanent. So that's interesting. The adoption credit, so if you adopt a kid, it's partially refundable now. Charitable deduction for standard filers, that's a nice one. I work with a lot of families who donate on a regular basis to charity tied to a church, and they're not getting any tax benefit for it at the federal level. But now they're going to get a little bit, even if they file as a standard deduction taxpayer, they could get a little bit of gravy on top of that. And then bonus depreciation and R&D. If you're a business, then that, expensing that will continue on a little bit further. Let me just give you a little bit of insight there. Whenever you R&D, that's research and development, by the way. When you buy an asset or you're creating an asset, certain expenses associated with that creation process or the acquisition cannot be expensed in the year you pay for them. In other words, the tax law requires that you capitalize these assets. Let me give you an example. Let's say that I decide to build some special technology or build a home, right? A home is a better example. I lay the foundation, and then I bring in the utilities and I start doing the framing and the insulation and the roofing and everything that goes on the inside. I can't write off. Every time I say write off, I think of Kramer telling Jerry in the apartment in New York of Seinfeld, just write it off, Jerry. You can't write off or deduct those expenses all in the year you pay for them. You add them up, and then the law requires that you take a certain percentage over its expected lifetime or usefulness. They passed certain rules like 179 deduction, bonus depreciation, which essentially allow individuals, business owners, to write off those expenses in a shorter period of time than just the regular standard depreciation schedule, which oftentimes is 3, 5, 7, 15, 29 and a half years, whatever it is, or 27 and a half, forgive me. It's 39 for a commercial property, 27 and a half for residential. So if you have a rental property, you can expense the purchase price over 27 and a half years. But with bonus depreciation and other things, you may be able to do that a little bit sooner. All right. The bill still needs to be signed into law, passed by the Senate. I don't think all these provisions will remain in the final law, but I think a good chunk of them will. And it's important for you to know how they impact you personally. I mean, at the end of the day, there's a lot that you can control from a financial planning perspective, but there's certainly a lot that you cannot. You can control how much you're saving, and you can control where you invest the money. But you cannot control the tax law, you cannot control the economy or the stock market. So just keep that in the back of your mind. Financial planning takes this all into account and ideally puts you in the best possible position so that you mitigate any risks that may come down the road and also take advantage of opportunities as they arise. Tax planning is just that. It's not just solely about reducing the amount of tax that you pay this year. Rather, it's mitigating or minimizing the amount of tax you pay over your lifetime. Catch the vision with me. Unfortunately, when you go to tax professionals and tax preparers today, their goal is to generate revenue from you, right? At the end of the day, they want to get paid by you. And you expect them to do what? Reduce your taxes as much as possible right now. they're less inclined to provide you long-term tax planning advice and insight because the compensation structure or model in which they make money is such that they pay you, they file the return, or excuse me, you pay them, they file your return, and hopefully you pay as little as tax as possible right then and there. What I'm suggesting, rather, is that you look at the long term and you see where Congress is headed, what incentives they're putting in place, and you play the game. Now, the nice part about financial planning and tax planning is you don't have to know all the rules. In fact, you don't have to be great at every single strategy that's out there, whether it's investing, retirement, whatever it is. But what you do got to do is be pretty good at just a few. And if you're great at a few, you'll have a great, successful retirement. You'll sleep at night knowing that you're taking advantage of the tax law instead of just letting the tax code happen to you, which really is what most people do over their lifetime. Maybe it's you. You work, you make some income, and you just let the tax code happen to you. Instead of being proactive, you're reactive, if that. So please take some time. If you haven't already, consider getting a copy of my new book, Finance on the Fly, Simple Strategies to Build Lasting Wealth. This is a plain English, simple, easy to understand tool that will take your finances to the next level. Of course, if you're looking for a get out of debt book or a budgeting book, this is not for you. Go check out Dave Ramsey or somebody else. There's many great books on that topic. But if you're already in a strong financial position where you're saving and investing regularly, and you want to be sure that financial independence and financial freedom is yours when the time comes, if you don't already have it, then this is the book for you. My name is Rizek. I'm a financial advisor who happens to be a CPA and certified financial planner as well. If you've enjoyed this, consider sharing it with a friend or loved one.
The Finance on the Fly podcast is for educational purposes only. Any ideas presented are not intended to be personalized financial, tax, or legal advice and are provided for informational purposes only. Rizek is not rendering or offering to render personalized investment, legal, or tax advice through this content. Investing comes with risk, including the risk of loss. Consult your own tax professional, financial advisor, or estate planning attorney to perform your own due diligence.